Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Dave Breazzano. How you doing today, Dave?
Good. How are you, Kirk?
Good, good. We brought Dave on because, we're really talking about a topic which I think most people find boring, but I think over the next few years is going to be a really exciting topic. And so we wanted to kind of dive in. As you know, we like to be ahead of the curve, so we're trying to get here way ahead of the curve. So, Dave, why don't you tell us a bit about your background?
Sure. Thanks, Kirk. So I started a firm called DDJ Capital Management back in 1996. Prior to starting that firm, I was a portfolio manager at Fidelity Investments, where I ran the Capital and Income Mutual Fund and co-managed their distressed investment operation. And before that, I was at T. Rowe Price and a couple other organizations. But for the bulk of my career, I was managing a boutique investment firm called DDJ, which was acquired by Poland Capital a little over a year ago. So we're renamed now Poland Capital Credit. But our focus has always been on the high yield market, including bonds, loans, public and private credit situations, and anything associated in the lower tier of the credit markets.
Okay, so I think most people know what bonds are. If they don't, certainly our expert Barbarapedia will let us know. But for the most part, you also mentioned loans and lower tier. So can you kind of explain what that is for our listeners?
Certainly. So loans is in the old days when banks actually lent money, they typically made loans to individuals, obviously, but also companies. And they are debt obligations issued by a company where they borrow money from a bank, and now institutions such as ours, but typically they're floating rate. So they provide an interest rate protection, if you will. If rates go up, the interest rate on the loan will adjust typically quarterly. And if rates come down, it will adjust down quarterly. They often have a benchmark like LIBOR or SOFR, and then a spread over that. So it could be like LIBOR plus 300 basis points, so 3 percentage points above LIBOR, and it adjusts. But it's a debt obligation of a company that has a maturity date, whereas a bond typically is a fixed rate obligation. It would have an established coupon, call it 8, 9, 10%. And so the company borrows money, pays interest at the coupon rate, and then at the maturity date, it pays it back. Private credit is similar. It could be a bond or a loan, but it's not publicly traded in the marketplace. Publicly traded bonds, by definition, people can buy and sell them, and they can be fairly liquid. Loans also can be traded. They call them syndicated. So other banks or institutions that buy loans will trade them amongst themselves, but it provides a market value. On the private credit side, they typically don't trade, and therefore they're often not marked to market. So the investor or the lender holds it at cost, unless some material event occurs and they have to either write it down or it's going to be taken out prior to maturity or something like that.
Okay. All right, good. So, when you're talking about kind of the lower tier, what falls in the lower tier of debt or loans or credit?
So there are rating agencies. The two large ones are Moody's and S&P, or Standard & Poor's, and there's also Fitch. They provide credit ratings for debt obligations, and there's a classification of investment grade. So the best credit rating is AAA, and there's only a handful of companies that have achieved that status. And then the investment grade part of the market goes down to BBB. So it's AAA is the best, AA, single A, and then BBB. Anything below BBB starts at BB, single B, and down to CCC would be deemed below investment grade. Years and years ago, they called those junk bonds because respectable people did not buy them They stayed with the investment grade part of the market. And there were certain regulations and reserve requirements and so forth that if you bought something below investment grade, there would be some onerous requirements. So as a consequence, the lower tier, which is double Bs and below, have a significantly higher yield to entice people to buy them than investment grade bonds. And there's risk, a higher perceived risk of credit default, where the company could get into trouble and maybe go bankrupt or not pay back the loan on time. But in return for that risk, there's a higher reward or a higher yield, and sophisticated investors can participate in that part of the market to try to find those gems, if you will, that provide this high yield, and the company never defaults. So hopefully that explains a little bit about the lower tier and why anyone would want to be there.
Yeah, that does. And it brings up a lot of questions. So I appreciate that. So one question I have is, you mentioned that the default rate certainly is higher in the lower tier. What would you say for like high yield bonds in general is kind of like a historical default rate? Because I know recently things have been, let's say, very few defaults, but historically that wasn't the case.
Yes, it's a very good question. So historically, depending on the time period, it averages or trended around 3 to 4%. Now, in severe economic situations like 2008 and 9, when people thought the financial world was ending, the default rate spiked into double digits. It got in excess of 10%, but then quickly came down. The last few years, because of the accommodating Fed and fiscal and monetary policy, the default rate trended like around 1% or lower. It's starting to tick up, but it's still low by historical standards. So one should expect over time a 3 to 4% default rate. And then the rate differs based on rating category. So investment grade bonds, triple Bs and better, have historically had lower default rates. And then the lower the credit rating, when you go to double B, single B, and triple C, historically the default rates have increased by those rating categories. But as I said just a few minutes ago, by historical standards across the board, default rates are very low.
Okay, no, that's good. So, all right. So if you look at kind of the historical rate of 3-4%, the question that comes up is for the last, I don't know, 10 years up until 2021, obviously we had a low default rate, but the yields were low. I mean, the yields are like 4%. So how does that market work, right? Because if you're expecting 4% and you're getting a 4% yield, that doesn't equate to very much.
Yes. The other important aspect that people often overlook, and I need to emphasize this, is something called recovery rate. So when a bond or loan defaults, it very rarely goes to zero. There is some asset value to the company that the creditors are entitled to receive before the shareholders get anything. So historically, that recovery rate, and the way they define it, is where does that bond or loan trade the month after the default? Historically, it's around 41 cents on the dollar. So if you have a 1% default rate, to make the math easier, and a 40-cent recovery rate, you lose 0.6% or 60 basis points. So even if the default rate is, call it 3%, on average, you're not losing 3%. You're losing maybe 1.5% in that range, depending on the recovery rate. Now, then there's something beyond that, that's where the bond traded right after the default. If you're an experienced investor, and maybe later in our discussion we can get into that, there's things that one can do to enhance that recovery rate so that you can recover actually more than 40 cents on the dollar at the end of the day. So one has to look at the default rate and the recovery rate to get what you lose, or the loss rate. Now, with a 4% interest rate when rates were low, you also have to dissect the overall market. As I said earlier, investment grade bonds have a lower default rate than high yield bonds and below investment grade bonds, and then each of those categories. And likewise, each of those categories has a higher yield spread. So whereas maybe, call it, just to make it simple, if a triple B bond was yielding 4%, a double B bond might be yielding 5.5%, and a single B bond might be yielding, 6-7%, and then a triple C bond could be yielding 10 or 12%. So as you accept higher possibilities of defaults and losses, the spread or the interest rate on those types of obligations goes up to compensate. And over time, and the history and the data shows this, if one makes reasonable credit selections, the interest rate and the spread that one receives more than compensates for the credit losses that one has incurred. So the higher interest rates that you get by taking on more credit risk, in average, or on typically, you're compensated for the theoretically greater losses that you can take. So that's how the math works.
Okay. No, that's great. I appreciate you kind of laying that out, because I think for a lot of people, it's funny because, most of the listeners probably know a lot about stocks, but they don't know much about bonds.
Mm-hmm.
Bonds is like this secret that people don't talk about. The institutions work with, the individuals don't understand it. They don't want to understand it. It's boring. Bonds are boring. It's just,
yeah.
I get it, right? It's not exciting, which investments are not supposed to be exciting, but, people want that. So, I appreciate you kind of laying that out. So one thing that I find interesting is this concept that, prior to 2008, the markets were somewhat normal-ish. But really since then, things have really, the bond market is really just kind of, well, I guess it's done well up until the last few years and has really kind of suffered since. We had a 40-year bond bull market, which must have been great for guys like you. But what about going forward when interest rates are going up? How's that going to affect bonds or high yield bonds for that matter?
Yes, it creates a new dynamic that I would say the vast majority of investment professionals have never experienced. I can say without giving out my age, I did start my career in the very early 80s. So I lived through a period when interest rates were much higher and actually had gone up. And I could say very few people practicing today have witnessed that. So it's a different dynamic. But I would also say that I think long term, for the health of the financial systems and everything associated with it, it's important that we have what we call high real interest rates, and by real, it's the interest rate less the expected inflation rate, so that bonds and loans can generate real investment returns. With the 40-year trend almost of interest rates constantly going down, it created a bull market for bonds, which now has ended. And it gave a false sense of security that these investments would always find a way to work out. And that's not the way the real world often works. There are risks out there, and people have to be mindful of what they are. But also, with that continuous decline in interest rates, to the point where we got to zero and sometimes negative real interest rates, a little bit in the US, but significantly in other parts of the developed world, where if you owned a bond, you were actually locking in a real loss. That's not healthy. And we're now seeing the consequences of it with the demise of certain banks recently, Silicon Valley Bank, to name one example. In a low or zero interest rate environment, financial institutions as constituted today in the way they were are not sustainable. A bank or an insurance company needs to invest in loans. They can't be 100% stocks. They're actually prohibited from doing that. So they have to have debt instruments. And if their debt instrument doesn't produce an adequate return to cover their operating costs, plus any credit issues they may have, nobody invests perfectly, then they're not sustainable. And what it did is it forced them to take on certain risks that maybe were unintended, but now have come to the surface, where they locked in a fixed interest rate on an asset that when the Fed raised interest rates, all of a sudden that asset lost value and they were deemed insolvent, or they could not sell that asset to fund depositor withdrawals without losing money. And it's a self-fulfilling spiral. So we now have a period of time where we've started to raise interest rates to what I would call an appropriate, more appropriate level, where people can actually make money in fixed income, and it will allow financial institutions to better position themselves. But when you do that, when the Fed and other central banks change course and cause interest rates to go up, there are consequences, and there are often unintended consequences. So you can't just rip the Band-Aid off and raise rates and expect the world to, be happy. There are costs to it. And we're starting to see the costs with some bank failures, but also people losing money, not only in stocks, but in bonds, which has been unusual for, several decades.
So, it brings up a lot of questions, because we've had negative real rates for a while.
Mhm.
And, I'm sure that's somewhat deliberate on the Fed's part, right? I mean, I don't know how else you get rid of debt other than inflating it away. But, the Federal Reserve has been really behind in raising rates with inflation as high as it was. I don't want to put you on the spot, but how do you think they're going? If I look at the if I look at inflation, right, and I look at the economy, I figure, like, what's the one question I can ask that would answer all my questions? And it would be, what is the Fed going to do? Right? Like, they're in a corner and they have to make a decision. What are they going to do? So I'm curious, how do you think about that? And what do you think that they're going to do?
These are great questions. So first and foremost, no one can predict exactly what the Fed will do, because one has to remember the Fed is not one person. It's a committee, and they get votes. Some people are more influential than others, but they're not unanimous. And depending on the direction of the wind or the way individuals feel on a certain day, can influence their vote with respect to whether to continue to raise rates or take a pause and what have you. So it's a difficult thing to predict. And maybe later in our discussion, I can go into how we address that type of risk. But my belief is that the Fed will continue to raise rates for some period of time. Hopefully, we're talking just a couple of quarters and we're almost there. Because the challenge, and the Fed has a lot of challenges, and to kind of step back, rates were low, and I would say too low. But the Fed was kind of in a quandary, because you have a lot of competing factors, political, of course, but also economic. The economy was in a precarious position for a couple of reasons. You had the 2008 tragic situation that could have, destroyed the economies of the world as we know them. So they had to take drastic action. But then you had COVID, which was somewhat unprecedented, where world economies were shut down to a large degree, and you had to restart those economies as well and stave off another financial collapse that could have been devastating for generations. So there were certain factors that caused the central banks and others to take drastic actions and unprecedented. And unfortunately, we're all humans. There's a tendency to not be responsive enough and timely. You kind of move a little bit slower than you should in multiple directions. But they went in that direction. But one of the challenges the Fed had for this extended period of low rates was we had massive federal deficits and a massive debt load. The U.S. had a massive debt load. People forget, S&P kind of downgraded the U.S. below the AAA status. So, people were mindful that there was a lot of debt out there. So if the Fed raised interest rates, it means the United States government has to pay a higher rate on its massive deficit. And that adds to the deficit and creates other issues. So there's a lot of tensions all the way around. And then, they weren't getting some of the adverse consequences that one would expect. For a long period of time, inflation was still very low, lower than what the Fed really wanted. And the Fed kind of wanted to stimulate things to get inflation up over 2%. And it was stubbornly low for a lot of reasons. And now it's reversed. And there are some big reasons as to why inflation spiked up. And I can name a couple just to kind of set the table.
Please.
There was many stimulus packages to restart the economy after COVID. And I would say the last one, which was something like $1.9 trillion, in my personal opinion, was unnecessary. You got to wait for the prior stimulus packages to do their job, and not all the money was spent. So when you add on almost $2 trillion, to put it in perspective, that's almost 10% of the US annual GDP. It's a massive amount of money going into the system that is going to people who will spend it. Americans are not savers on average, so they will spend it. And when you add 10% of the GDP in fresh cash to people who are going to spend it, they want to buy things. And then you also had supply chain problems. To put that in perspective, one example, we used to produce and sell about 17 million cars and small trucks. And for supply chain issues and other things, we're now it's starting to step up. It got down to like 13 million to 14 million. Well, you used to make and sell 17 million a year, and now you're at 13, but you have all that extra money and people want to buy things, including cars. The price is going to go up because you got those dollars chasing fewer goods and services because of supply chain issues. So it's inflationary, no way around it. And it's not just the Fed that controls it. So the Fed, acknowledged it had to do something, or this was really going to get out of control. And they have limited tools. But one is they could raise interest rates, which they're doing. But you also need cooperation on fiscal policy side. The government has to spend less money. You can't have them spending a lot of money and the Fed raising rates and hope to get inflation under control, because they're going to be competing against each other, and that's not a good situation. So there's a lot of parties that have to kind of come together to make a coherent policy to try to get inflation to a more realistic or normal level, or acceptable level, if you will. But recognize that you still have that 1.9 trillion of cash sloshing around the system. And when one person spends $1, that dollar gets spent again and again. You go to a restaurant, spend $1, give a tip to the server. The server takes that money and he and she goes and buys something. The restaurant goes and buys more food, and there's a velocity of dollars. So the money gets spent multiple times, and that continues to feed inflation. And just raising interest rates once or twice isn't going to rein it in. So the only way to rein it in is to put the brakes on the economy and force people not to spend so much, so that the supply and demand of goods and services is more in check and inflation is under control. But that doesn't happen right away. It takes a while. So oftentimes policymakers are very impatient. And my frustration with the Fed is, one, you got to wait for some policies to actually take hold. Just because you raise rates tomorrow, people don't change their behavior. It takes a while for that to happen. And my experience has been that they go too far and then regret it after the fact. So long-winded way of saying, I think there's going to be, I would expect some more rate increases. And I would expect that they would probably go a little bit too far, and we're going to have a recession at some point. I can't predict exactly when that will occur, but that's the only way to rein in inflation. You got to slow the economy down, and that means economic activity has to slow down, and it's not a science. And we could and likely should expect a recession. Hopefully it's mild.
But isn't that effectively what they've been saying, is we're trying to destroy demand, which in in Fed speak is we're trying to cause a recession? I mean, this is the part that I find interesting, is they've been saying that for many, many months. They've been saying they want to destroy demand, effectively cause a recession. And the market keeps coming back and saying, yeah, we don't believe you. No, we don't believe you. No, we're really going to do it. Yeah, sorry. You cried wolf too many times. We don't believe you. So it kind of leads me to wonder, what is it going to take to actually, first of all, to actually get a recession? Because for whatever reason, these high interest rates haven't caused it. Although I would argue maybe it's starting to this year. It just takes 18 months. But I think the big question is because there's that lag in policy decisions and actually what happens, is it going to lead to more things like, SVB and Signature Bank and more things like that? And I don't know if you're an expert on banking, but I think it raises the question of, what is, based on your understanding of the fixed income markets, what kind of areas are susceptible to problems when it comes to a rising rate environment? Not necessarily in like default, but necessarily in like the system kind of breaking and seeing more SVBs and signature banks, and or maybe issues in the in the fixed income market. So in your experience, like what areas should people be wary of at this point?
Yeah, the first and more obvious one, and that's what I think hit SVB, Silicon Valley Bank, was interest rate mismatch. So if one, like a bank, they source their money through floating rate deposits that people can take out in a moment's notice. So they're not sticky long-term assets. It's a deposit that the individual or company can withdraw today, tomorrow. So and what they did, because of the low interest rate environment, they couldn't get a reasonable return on their asset side, their loans that they were making or the assets they were buying, to fund the meager interest rate they paid on deposits, and very little, but also their operational costs to run a bank, all the people that they have working for them, and their branches that they have to pay rent on, and all those other operating expenses. So to get higher interest rates to cover those costs and give them a higher operating margin, they could get a higher rate if they went on a longer maturity and a fixed income loan or bond. And they bought securities that were longer duration, so longer maturity with a fixed rate, to get extra interest. And it wasn't really a lot. As you're talking 20 basis points, maybe more rate, but they viewed that as an acceptable risk, because we all knew interest rates were never going up. They haven't gone up in decades, until they do go up. And then when they did go up, the value of those longer term fixed rate assets came down, because as interest rates go up, prices of bonds, not only stocks but bonds, come down to mathematically get the appropriate interest rate in that security. And then if people took their deposits out, they have to sell those obligations to fund those deposit withdrawals, but they got to sell them at a loss. And then all of a sudden that loss gets reflected on their financial statements, and regulators and other people say, oh my God, they're losing money, or they got a real problem. Everybody's got to get their money out, and that's the end of the bank. If everybody takes their money out, they're done. So it's that mismatch of sourcing money short-term at floating rates and investing money long-term at fixed rates can create a real vulnerability that then appears when interest rates go up. Because as long as interest rates are kind of stable, it doesn't matter. But when they move up, then you got the problem. And it's an unintended consequence. And I think it's some of these factors that typically are the ones that the Fed and others can't anticipate. And that's what kind of pushes us into the brink of a recession. It's usually never the obvious things. It's always something sort of out of left field. They go, oh my God, I didn't expect that. And then there's consequences and repercussions, or in the banking community, we call contagion, where somebody says, well, if Silicon Valley goes down, what about, First Republic? And now their stock's getting hit and they need a bailout. And what about Credit Suisse, and so forth. And then people look around and go, uh-oh, what other bank is vulnerable? And that contagion becomes self-fulfilling. And then all of a sudden now we've got a real problem and a systemic issue with the health of the financial markets. And that could put us into a recession. So it's not necessarily just raising rates and having people stop buying an extra TV or a car. It's, oh my God, I'm scared of the banks. I got to get my money out. And now companies and people can't borrow because there's a gridlock in the financial service area. And then we have a real problem. So those are the things that I think tip us into a recession, not kind of the obvious ones. It's this other stuff coming out of left field that people didn't fully appreciate.
Yeah, and I think that's always the question, is where are the black swans hiding, right? Because the known problems are never problems.
Correct.
Right? Like 2020 is an example, and I'd love to get your take on this. 2020, every Tom, Dick, and Harry in the financial institutional space was talking about the high yield bond space and how it was on the teetering on the edge of a big problem, which is more operational. It was more like operational than actually, specific issues. But when that happened and the Fed came in and said, we're going to support everything, they didn't actually put a cent into it, but they said, we're going to buy all high yield bonds that you need to buy. And they never bought a cent because they just verbally supported it. So they were aware of the problem because everybody was. So it wasn't actually a problem. I obviously, the unknown unknowns, you don't know. So how do you know what the problem is? But do you still see that problem before of, and I'll explain it for the listeners, and for you, just in case you know what I'm talking about. I know you do, but just which problem? So there was a problem up till 2020 where effectively more and more companies, it was like 40 or 50% of corporate bonds were like triple B. And it just more and more companies got lower and lower ratings, and they were still investment grade, but they weren't junk. So the fear was you go into recession, all those teeter into junk, and now you've got this huge amount of money swirling back and forth from investment grade to junk, and you got to swap portfolios and just be a mess. So can you kind of describe that a little bit? And then has that been fixed at all, or what do you see as a problem there?
Yeah, that's a great point. An example of what happened, and I always remember, March 23rd, 2020, when the Fed just said, we're all in and we're gonna fix this mess. It was just dumping a massive bucket of money into the system, and it worked. It shored up the system. We can argue now we're paying the piper, but it is what it is. So what happened was the significant part of the credit markets became triple Bs, which is one notch above double B, which is the junk or below investment grade or high yield category. And institutions have certain guidelines. Certain institutions cannot own or don't want to own anything that's below triple B. So it's kind of a bright line test, and that's creates the opportunity, but also the risk. So when a bond goes from triple B to double B, the price drops because there's more sellers and the yield shoots up. So there's a big incremental increase in yield. But what happened with the shutdown of the economy from COVID is there were massive downgrades. And the agencies, the rating agencies, are run by humans as well, who try to anticipate things. And try to be accommodating where a reason. So there were many triple B companies that in another time, 20 years ago, might have been double B, but things were generally pretty good. So, we're not going to downgrade Ford. We're not going to downgrade Occidental Petroleum. They're kind of right on the cusp. But the minute COVID shut down, those bonds and others got downgraded, and there was a massive amount of selling because all of a sudden they were not permitted investments by certain institutions that can't own a double B rated or have limits as to how many they can own. And those bonds all of a sudden came into high yield or junk bond land. And there's only so many people like us that could buy them because, we're generally, most of our money is fully invested. And so you get these massive downgrades, and these are big companies coming into a market and not enough buyers. So you had a phenomenon like, I'll use one, Occidental Petroleum. Their bonds went into the 50s, so 50, 55 cents on the dollar, because they got downgraded, people had to sell, and oil prices at that time were low, so people thought that, they have real operational problems as well. And Ford got downgraded, and those bonds traded down, 10, 20, 30 points. It was a massive dislocation because it took a while for the high yield people to do their credit work to say, oh, I got to analyze Oxy, I got to analyze Ford. I never looked at these companies. They weren't in my universe. And before I buy them, I want to at least know what I'm buying. So there's a period of time that the market needs to accommodate and adjust for it. So you had this massive dislocation. Then once the dust settled and buyers understood, investors understood those situations, then the prices, normalized a little bit and they moved back up to reasonable levels because the market could finally digest it. So it was this massive inflow of supply to the high yield market that overwhelmed the market for a period of time. And it took the high yield market some time to digest all that new supply. And then, and the Fed had to step in, or they chose to, and it was probably the right thing at that point, to stabilize the market, or we'd have total chaos. And that's not good for everyone. And what they did is just giving that confidence to the market by saying, we'll buy, these double Bs and triple Bs or whatever, if there's market dislocation. Then people say, okay, if I know I can sell them to the Fed, then I won't sell it. And so they don't actually have to buy it. They just have to say they would buy it. And then people get confident enough to hold it. And then the market normalizes. And then a wonderful thing happened for anybody in our credit space is other companies could say, well, the market now has stabilized and we know the Fed is going to protect our backs here. So we have like this period of good liquidity, and any company that could refinance its balance sheet because rates now are low. And so if I have, a 7% bond on my balance sheet, I could refinance it with a 4% bond. Well, I'm going to do that. And I'm going to kick out the maturity for, 5, 7, 10 years. So they extended their maturity debt profile, lowered their interest rate, and in some cases loosened up the covenants. So any reasonably qualified company was able to do this and fix their balance sheet so that they don't have any real debt maturities in the near term because they spread it out. The companies that were in bad shape and couldn't do it got flushed out of the system, and they did default and get restructured or went away. So you had this period in 2020 where the whole market got cleansed. The reasonable companies could refinance and fix any balance sheet and liquidity problems they had. The few, but some, meaning, companies got flushed out of the system because they defaulted and they were gone. So you're left with a pretty good market statistically wise. So that's why default rates went to 1% and lower, because there was nothing to really create a default. The company didn't have any maturing debt. Its interest rate was low. And if it was a bad company, it already defaulted. So it was gone. So the world kind of became good. And when you have a good world, it causes people to get more confidence and then start doing some dumb things. And you have a couple banks that are examples of that. The world was good. Interest rates are never going up. I'll go long on my assets and fixed rate, even though I have floating rate short-term liabilities, and as long as things stay the same, I'm fine. But if interest rates go up, I got a problem, and now we're seeing the problem.
So, it brings this issue of moral hazard to kind of a point now, because they've been doing this for a while. This was obviously the concern in 2008, 2020. I am curious. Well, I guess we can kind of dip into that in the interest of time, but I am curious. I mean, the SVB and the Signature Bank were basically a bailout, for what MSNBC deemed as the Democrats' ATM, which is what they called SVB, which I thought was a pretty funny comment coming from that station. But I think what's interesting is that we're in a precarious situation where there's a lot of cracks in the system, and you don't know where they're going to come from. But when you look at a free market, the whole point of a free market is it should price itself accurately, and that accurate pricing should be baked in. So if you have a high risk loan and it's high risk, then you should be paying 12%. If it's a low risk, you should be paying 2 or somewhere in between. But with the system the way it was, I mean, we had high yield bonds at like 4.5% prior to COVID, which is ridiculous. Well, I guess if there's a 1% default rate, it's okay. But in general, historically, it's kind of ridiculous. So, I want to get into opportunities next, but, how is this possible to be fixed? Or do we just kind of wait until the system breaks and then fix it then? And the other half of the question is, what opportunities are going to come of this? Because what we're seeing is effectively a system that's kind of cracking and breaking at the seams. But with problems come opportunity, right? And I don't want to be a vulture capitalist, but I'm a capitalist, and I like underpaying things rather than overpaying for things. So where do we see the opportunities coming up, depending on obviously the direction of the markets?
Yeah, there's a lot there. I just make a very quick comment on whenever there is this type of bailout, there's a tendency for that unintended consequence. And I'll look back to, I can position '08, really the start of it, and who knows, but is around 2000, 2001 and all, when long-term capital went under and Lehman was teetering. And I remember being kind of criticized when I took a view in a conference saying, they should just let them go. And they said, no, it would, really harm the financial markets and so forth. They got to bail them out. And that's the mentality at the time. But what it does is then it sends a signal that, well, you can take a lot of risk. And if you mess up, you get bailed out. And if you don't mess up, you become a billionaire. So why wouldn't I take all this risk? Because I have no real downside and I have all this upside. It's skewed. And then you get 2008, because then when it does blow up and people can't stop the implosion, it's really it decimates the system. So you kind of got to let things fail, and you got to kind of get beyond, it's going to hurt, because you just put a Band-Aid on it, you're rewarding bad behavior, and it comes back to bite you in a bigger way. So I'm not a huge fan of bailouts, but as long as there's some infliction of pain on what I would say the parties that should bear it, like shareholders and the like, that's appropriate, because they should know that they're taking that kind of risk. I do think there should be some stability for depositors and for people who own insurance policies, because that's money that less sophisticated people are relying on to be worth, 100 cents on the dollar. Their deposits and their retirement plans, or their life insurance policy and things like that. But anything else is fair game. If you buy a stock or a bond in a risky venture, you should accept the possibility of losing money. And that's how you rein in excessive bad behavior. So that's kind of my belief. Now, going forward, I think, individual depositors should be protected. We can debate whether if you're above the insurance limit, you should be protected or not. That's a political debate, and I don't need to get into that, but you can draw lines various places. But at some point, you do need to protect the average investor, the average depositor, if you will, but not necessarily the more sophisticated, larger one that knows what the rules are and decides to ignore them. So it's a different line. So that kind of sets the table. Now, I think you asked about opportunities.
Yeah, like we're going into a time period which is very precarious, and with precarious times also comes opportunities. So
Yes.
I'm wondering what you see as you manage portfolios. Like, how are you positioning for opportunities, and what would just have you like ecstatic if this happened? Like, what would you see would be like, wow, like 2008 when you had like 20% high yield bonds, because it just things were crazy. So like, what does that look like for you, and what's a good opportunity for you?
Yeah, so we like volatility because it does create opportunity. If everything is just kind of stable, everybody's like kind of looking at the same data, and there's not a lot of differentiation between risk and reward, if you will. It can get boring. But when you have volatility, what typically happens is markets, again, are run by humans, and people overreact. So people get scared, they start selling everything, and they sell some good bonds and good loans at the same price that they sell bad loans and bonds for, because they're just looking to sell, and they'll sell whatever they can. And it creates an opportunity for people like us to distinguish between the different companies and credits and find a really good one that we're comfortable with is going to be able to repay that debt according to the contract, trading at a price similar to one where we think there's a lot of risk. And so we can buy those good ones where, the whole system temporarily gets tarred with the same brush. So they throw the baby out with the bathwater, as they say, and we can buy those good credits at very inexpensive prices or very high yields. And then, given time, the market and analysts come in and they have time to do their work more and distinguish and say, oh yeah, those are good credits. They shouldn't be this cheap. So then the price of the good ones comes back, and that's where you generate good returns as the market then does greater work, settles down, and better prices the risk profile of different companies. So the way we do this is analyze each individual company on its own merits and how it will perform based on our view of the future economy. And to be conservative, we're viewing that there's going to be a recession, and we're viewing that rates are going to continue to go up. And so the company's going to, if it has floating rate debt, it's going to have to pay more interest, and its revenues and costs are going to be under pressure. So its profitability is going to struggle. And we look for companies that, even under these pessimistic scenarios, within reason, we're not assuming the end of the world, within reason, the company can survive. And if it can, and it's got a really nice juicy yield, and we're seeing yields double digits, over 10%, that's a bond or a loan that we will buy. But conversely, if we look at the situation and we say that company's in trouble, then we just avoid it. So the way we attack the market, and what our philosophy is to be relatively concentrated. So in our portfolios, depending on the client guidelines, we'll have 70 to 80 to 90 different names in it, which for a fixed income portfolio is generally deemed as fairly concentrated. There are other high yield managers out there that have 400, 500, 600 names in their portfolio. They're just buying the broader market, and distinguishing between the different credits is not that important to them. They just kind of buy a little bit of everything that's out there and just hope that the broader market will take care of itself. And if they have a problem, it's small, but then there's no reward. We like to be a little bit more targeted. If we really know the company and really believe that it can survive a pretty challenging time for the next several years, and it's paying us over 10% of a yield, then we say, yeah, we understand the company. We think it's going to pay us, and it's got a double-digit yield. We're going to buy it. And if we can't get comfortable, if we say, well, maybe there's this risk that could happen or that risk, or there's something we just can't get our arms around, or I'm not comfortable making that assumption, don't buy it. Because we have thousands to pick and choose from. We don't have to buy it. Other competitors might just say, well, I'll just make it a small position. And we go, well, a lot of small positions can add up to a big problem. So we want to know what we own and make it a meaningful position, not excessive 1 or 2% position, but really be comfortable that that company's going to pay and give us a good yield. And we look at the major risks. We talked about them. There's rising interest rates, there's inflation, and there's a potential for a recession. So in our analysis, we try to anticipate a recession, how the company will perform. And so we get comfortable there. We can't predict how long inflation will be and how much it will be. And we can't predict what the Fed is going to do in the near term and medium term on interest rates. So how do you hedge against that? Well, if we have a healthy portion of floating rate debt in our portfolio, so if interest rates continue to go up, the yield we're getting on our loans will go up. So we're insulated there. And then our duration, the maturity profile of our portfolio is relatively short, because with floating rate loans, they have a very short mathematical duration. They're somewhat interest rate insensitive. And then the fixed rate bonds that we hold typically are less than 5 years to remaining maturity, and considerably less. So our duration on our portfolios is 2 years-ish. So it's not that sensitive to interest rate rises. So we can effectively protect our clients from any significant continued rise in interest rates. And we do it on the credit side. And then as part of our analysis, we look at the inflationary impacts on the credit profile of the company and try to identify companies that we think can pass along inflationary cost increases that they may incur, so that they can maintain or defend their operating margins and do okay in a continued inflationary environment. So that's how, we can't predict what will happen with these things. So we make certain conservative assumptions. And if we're too conservative, that's wonderful. And if we're just on mark, well, that's okay too. We get what we bargained for. So floating rate, short duration, and really thorough due diligence and a concentrated portfolio, not just buying everything that's out there, is how we can deliver value to our clients and navigate this treacherous environment.
Great. Well, Dave, we got to, in interest of time, wrap it up here, but I really appreciate you coming to the show and sharing your wisdom. I know this space is going to be hot for the next probably 5 to 10 years, if my spidey sense is correct. But yeah, if you could tell the listeners where we can find more about you, and we can go from there.
Yeah, so thank you. It's Poland Capital and Poland Capital Credit. We have a website. You can search there. It will list all our different strategies, our equity and fixed income strategies. And as I'm a fixed income person, I would say definitely look hard at the credit strategies we have, because now we have real significant interest rates that allow us to generate a high yield for our clients. And even though bonds have been volatile of late, over time, they're less volatile than equities. So you get a high yield. In some cases, we have portfolios that yield double-digit yields, over 10%, with some amount of price stability because they're bonds, not stocks. And it gives you an alternative to equities that now is reasonable. A couple of years ago, with a 4% or 3% interest rate environment, you couldn't make much money in fixed income. Now you can. And so PolandCapital.com, and you can see our products.
Awesome, Dave. Well, really appreciate you coming on the show. And like I said, I think we'll probably have you back because, like I said, we'll be touching on this again. But really appreciate you sharing your wisdom with us, and look forward to talking to you soon.
Yep. Thank you, Kirk. I've enjoyed it.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, well, that was a great interview with Dave. Really appreciate him coming on the show. Always enjoy getting different perspectives from people in areas that we don't talk about every day. And nothing better than talking about boring bonds, but yet they're not boring anymore, or at least as of the last year, which is really exciting for me. And I know when we talk on our panel here, we're really going to be diving into this. And we're going to take a boring topic and we're going to liven it up. And I think you're all going to be excited by the end of this episode. So we're in the panel portion of the show where we have our very own Barb Friedberg. Hey, Barb.
Hello, everyone. Finally, we're talking about bonds. Can't wait.
Awesome. We also have our very own Megan Gorman. Hey, Megan.
Hey, Kirk. How you doing?
Doing great. Well, let's just dive right in. So let's start with you, Megan. What were some of your takeaways from the interview?
Well, first of all, I mean, I loved this interview. If you heard Barb and me before the show, we were just gushing about this guest. So what I really, really enjoyed about this interview is this is a real deal bond manager. This is someone who spends his entire career managing bond portfolios, really understands the space. And what I loved about it is, Barb, he was like your Barbopedia soulmate in how he defined things. And so he made it bonds, I think, very bite-sized and easy to digest, which is really hard to do because stocks are sort of easy to understand. Bonds are like, it's an opaque world over there. So I really felt if you want a basic bond 101, this was a great interview to listen to.
Yeah, I totally agree. I really love this interview. I really enjoyed talking with Dave. Barb, what about you? What are some of your takeaways?
As you all remember, over the past decade or so, interest rates have been hovering around zero. So who would have any interest in investing in a bond, which is typically just a loan to a corporation or a government, where in exchange for your loan, you get like 0.5% of interest per year? Well, that just stinks. Nobody likes that. But now, as the Fed is raising interest rates, bond yields are increasing and they are becoming a lot more interesting. And actually, over the past 100 years, average bond rates on aggregate have hovered around the 5% range. So we're finally approaching a level where bonds really make sense to add to your portfolio.
Hey, Barb, can I ask a question? Because it's a big debate we're having with clients right now. So first of all, I'd love to have a little discussion on duration. What is it? And today, why is it like the hot topic?
Well, duration is, for practical purposes, the time length of the bond to maturity in practical purposes. So you might have a bunch of long-term, short-term, intermediate term bonds in a fund with a duration of, say, 5.2. 5.2 is going to give you, the investor, a sense of the maturity of the aggregate portfolio. Another thing duration means in a practical sense is because bond prices are very sensitive to changes in interest rates. And so the duration will tell you how much a bond price will change when the interest rates change. So if interest rates go down 1%, then the value of the bond will go up 5.2% approximately. So it gives you an idea of how much volatility you can expect when you invest in a bond. Not an exact science, but a ballpark.
And I think he talked a lot in the interview about the mismatch that happened at Silicon Valley Bank. I think he put it quite elegantly that they went too long on duration, which boxed them into a corner. And so here at my firm, we've been staying very short in duration, right? As the Fed's been raising rates. And now as we start to feel that they're tapering, the big thing we're trying to work through with clients is how much duration do we add, right? Do we stay incredibly short, or do we start to be more intermediate in duration? And we're finding that we're probably going to want to be more intermediate in duration. But again, it's not a perfect science, right? And what we're trying to do is really protect clients in both the principal they have in the bonds and the fact that the yield is actually paying them today. And Kirk,
let me
Barb?
elaborate on that, because that is the exact conversation I'm having with myself. So I'm glad I'm not alone, talking in my room like an idiot. But when you said you're staying relatively short in duration, the reason for that is because short-term bonds are less sensitive to changes in interest rates. So should the Fed continue to raise interest rates, the value of your bond is going to go down. But short-term duration bonds will lose a little less in value than will those longer-term, longer duration bonds. So for those of you listening, that's why most investors today are saying, I'm going to stick with short-term duration. So as interest rates continue to rise, I'll get the higher interest rates in a very soon amount of time, and I'm not going to lose too much in value. But the key for investors to think about is, well, once the Fed reverses course and starts to reduce interest rates, then your bond portfolio is going to go up. But we all want to lock in a higher yielding bond before rates start to go down.
Yeah, so I think these are all great points, and I'll give my 2 cents here. So I'm looking at right now kind of the what's available for yields across different bond categories. So I'm just going to list a few here, just so I'm not, when I'm talking, it's not into the ether. So if I look at like U.S. Treasuries, right, which is as safe as you can get according to credit agencies, even though they're not AAA as it used to be. But if you're looking at 0 to 1 year, you got 5.25 for U.S. Treasuries. 1 to 3, you're looking at 4.6. 3 to 5 is 3.6, and then 5 to 7 is 3.45, and then approximately it evens out there. So I mention this because really short term, to put this all in relative perspective, right? So when Megan and Barb were talking about in the short term, you're getting 5.25. But if you go out 10 years, you're getting 3.5 or 3.4. We say, well, why would you do that? Why would I buy 3.4 when I can get 5.25? That doesn't make any sense. Well, this is the conversation we're having now, right? Is where do you go on the duration from 0 to 30 years? Should you buy the 30-year bond, or should you buy the 60-day bond? For those of you who are squirrel-minded and they can't wait, right? The whole marshmallow test, the people who can wait tend to do better. If you can wait, you might end up doing better. But if you can't wait, you're saying I need yield now. Well, 5.25 looks pretty good. Now, the challenge with going with the short term, like the 1 year or less, and getting 5.25 is, what happens in a year? Well, what if rates are 2% in a year? Well, now you got to buy 2%, as opposed to buying, let's say, a 3-year bond now, which is paying 3.5, which would be better, right? So you're basically balancing today versus the future. And the one thing I like about bonds is it's heavy in math. And the one thing about math is math isn't wrong. So if you know the math, everything else is pretty easy. Things can default, rates can change, all that. But if you look at the math and you can kind of do it yourself in your head, you can make good decisions. It's not like a stock where you're like, oh, I hope it goes up 20% this year. No, this is clearly 5.25. You can get 5.25 this year. At the end of the year, you have to go find a new bond, right? Or the 10-year, you get 3.5. For 10 years, you get 3.5. So you have to balance out what that cash flow is over that time and decide, is this going to make the most sense? Now, the challenge that we're facing right now is the market is in a state of disbelief of what the reality is versus what they think it should be. And we talk a lot about in the show, the markets are a future pricing mechanism, a discount pricing mechanism. So they're looking 6 months and saying, what's going to happen in 6 months? That's how the stock market operates. What's happening today is what they think is going to happen 6 months from now. Now, with the bond market, they're predicting that within the next, 6 to 12 months, rates are going to start to drop. Well, I don't know about anyone listening to the show. I've seen no indication that rates are going to drop or we're going into recession or any of that. There's no signs of a recession, or the signs are very, very limited. There's no big signs that, even though everyone's talking about a recession, the signs are pointing to, we're not seeing it yet. We're all waiting. We've been waiting a whole 12 months. We're not seeing it. So there's this kind of speculation of when the recession is going to happen. But I think the pricing of the bonds is based on when people think there's going to be a recession. So if people think the recession's in 6 months, they're going to say, all right, well, rates will probably drop in 6 months because Powell will come out and say, oh, we're dropping rates. We're going to save the economy. I'm in the camp of, I think rates are going to be higher longer than anybody thinks. So in 2008, when the markets crashed, my speculation was rates are going to be lower longer than anybody thinks, which is what happened. What I think now, at least for the foreseeable future, is rates are going to be higher than what longer than a lot of people think, because the Fed has clearly stated that they're going to bring us in. They're going to just basically raise rates to help destroy demand, which in layman's terms is cause a recession. So they're trying to cause a recession to slow down the economy. And until that happens, they're going to keep rates high. So if we have the market crash, or it goes down 30, 40%, whatever it is, then we might look at, all right, are they going to lower rates? And I would still say there's a speculation because it depends on inflation. The Fed's biggest fear right now is that inflation starts to take off like it did in the 70s and reaches double digits and gets really high, and that's a problem. That's one of their biggest fears right now. So that you have to keep that in context of, is this going to allay their fear of double-digit inflation? And so everything they do is in that context. So they're going to keep rates high to keep inflation low. As long as inflation is below, I think, they could lower it, but I don't think they're going to drop rates like people think. We're not going to go back to zero anytime soon. We've probably got at least 6 to 12 months before that even becomes an issue. But even then, I think it'll probably stay higher longer than people think. So so just looking at treasuries, that's one piece. Now we've got all these other different kinds of bonds, which, Barb and Megan can talk about, but, that's a different perspective of how we think that the market is going to react. Or what we've seen in the last year and a half is that the market speculates one thing and then it keeps moving the needle. It's like, oh, it's only going to go up, 100 basis points, and it goes up 200. Well, it's only going to go up another 100 basis points. So the market is slowly reacting to this change. They're not accurately predicting the future. They're just adjusting slowly, which has caused the market to kind of balance and hit an equilibrium, so it's not crashing. I have not predicted we're going to have a crash. I don't think we're going to have a crash. I think that would cause an event. An event would cause a crash, but I don't think that's in the cards. I think it's more of a slow slog, or I think John Malden called it muddling through, I think was his term. And so, I think that's probably a more accurate depiction of what we're going to see. But I don't know, Megan, I mean, if you're looking at portfolios, I mean, there's many kinds of bonds. We talked about treasuries, there's high yield bonds, there's munis, there's different levels of corporates, there's agencies, there's CDs. CDs are paying a great rate, 5% for 5 to 7 years now. Now it's probably with First Republic Bank, but other than that, I mean, there's some pretty good rates out there. So what are you seeing?
Yeah. So first of all, I think when you're constructing a bond portfolio, you've got to also be factoring in taxation, right? Tax always rears its ugly head. And you have to remember that different types of fixed income will have different tax consequences. So, right now we're in a marketplace where treasuries and agencies are getting a lot of press. Treasuries and agencies are taxable for federal purposes, tax-free for state and local purposes. In comparison, you've got municipals that are tax-free federal, and if they are from your state of residence, they will be tax-free in that state. CDs are 100% taxable. High yield savings accounts, 100% taxable. So as you go to construct a portfolio, know your tax rates, because there's a lot of retirees out there who are not in high brackets. And so doing taxable bonds are not a painful thing. There are other people today who are in high brackets and taking on more, income that would be taxed at the highest rates might not make sense versus a yield that's tax-free. So when you're constructing a bond portfolio, when my firm looks at it, and I think this is pretty common, most people see it as the ballast of the portfolio, right? So a lot of times the core holding in it is either municipal bonds or taxable bonds that are high credit quality. And even though that's the core holding, you want to complement it with different areas of the bond market, right? So he talked about some of these areas like high yield, right? Where you're stretching on credit to pick up yield. So other areas of the bond market where you would want to add exposure in your portfolio are things like total return, right? And these are typically actively managed. And these are things like opportunistic bond funds, things like mortgage-backed bonds, or total return strategies. And often you'll see the word total return in the bond fund, mutual fund title. You probably also want exposure to international fixed income, both in the developed markets and in the emerging markets. And then he also brought up one of my favorite asset classes, which is private credit. And private credit has been incredibly interesting over the past year. And it's where you're seeing a lot of high net worth investors deploying funds. Private credit is really a chance of, companies who are in need of debt financing seeking financing from oftentimes what we call a direct lender. And these direct lenders lend, they're typically not banks, but they make loans to companies that are done through contracts and covenants. And oftentimes these types of contracts lay themselves high in the credit chain. So they're usually one of the first people to get paid back if there was to be a default. And in the private credit market today, we are seeing yields of 8, 9, 10, 11%. Now, mind you, they are all taxable, but a much higher yield. So if you think about your bond portfolio, the core bond portfolio should be in high credit quality municipals or taxable bonds, but you want these nice little segments around it to help you navigate the overall bond market and get proper exposure.
Okay, great. No, thanks, Megan. So Barb, thoughts for you, like what are the areas that you like right now? I know you love bonds and this is your chance to shine, Barb. You've been waiting 20 years to talk about bonds and now we can.
I have. I remember when I was in high school and we went over to a friend of the family's house. He was a big trucking executive. And my father and the other father of the family were talking about investing, and my dad's talking about stocks and bonds. And this was at a time when interest rates were through the roof. And the guy said, I'm investing in 30-year treasuries at 10%. And I'll never forget that. And of course, today I would love a bond, a 30-year treasury that pays 10%. I don't think we're going to get back to that. And that was a time when interest rates, when inflation was in double digits. So what does this mean for us? It means that you have to decide what portion of your portfolio do you want in bonds. Bonds, like Megan said, they're a ballast. So when stocks are going crazy, up, down, very, very volatile, bonds typically are not as volatile. Additionally, stocks you get a dividend yield and capital gains that make up your total return. Bonds in general, if you buy an individual bond, hold it till maturity, you will get your principal back at maturity and you will get a cash flow. If you buy a bond fund, the value of that never comes back to maturity for you, although it will within the individual bonds. So you want a portion of your portfolio in bonds. If you appreciate a more stable value portfolio, and if you want some cash flow. I liked the categories Megan was talking about, but for most everyone except very wealthy people, you're going to look at funds over individual bonds, because in order to have a diversified bond portfolio, you need 10, 15, 20 issues. And there's a lot of really smart people. I'm in the midst of writing an article right now for Forbes Advisor, which is called The Best Retirement Income Funds for Investors. And in that research, what I have found is there are some stellar bond managers with really excellent bond funds, diversified funds that give you a relatively stable value or some appreciation along with a good cash flow. So to wrap it up, my advice to you for bonds is consider having a percentage of your portfolio, even if you're young, in bonds. They do have a purpose. Like Kirk, I don't believe interest rates are going back to zero. That is such an anomaly. It's never happened before. I think the conditions for it to happen again are unlikely. And so you want that little cash flow. And you want the ballast or the assets that will temper the volatility in your portfolio with the very, very big ups and downs of the stock market. Younger investors will have a smaller proportion in bonds, and you can get any sort of strain of fund, that you want, from high yield to corporates to treasuries, and they all have different characteristics. If you're near retirement, you probably want a bigger portion of bonds in your portfolio.
Yeah, that's great. I appreciate that, Barb. So Megan, I want to ask you, because you talked a little bit about some of the different types of bonds, and I wanted to get into maybe like allocations and how you think about that or look at that. Because as I'm looking at this kind of bond grid of different maturities as well as different grades, they're all over the map as high as borderline junk. Actually, it's not technically junk; it's still investment grade. You're getting like close to 11%, and downwards of I think like 3.5%. So, how do you?
Excuse me, let me interrupt here, Kirk.
Okay.
Where can you get an 11% investment grade bond?
Well, I'll just pull this up, and I won't name the company, but it says corporate triple Bs, 3 to 5 years, 10.993%, and it looks like that is well, it happens to be a bank. Go figure.
Okay, there you go. And just out of curiosity, and then I will stop interrupting you. What screener are you using?
This is something I use through TD Ameritrade, so it's just
Okay,
it's an
okay.
internal
And
thing that they
all of you out there, and again, please excuse my rudeness for interrupting, but all of you out there, if you have an account at one of the big investment houses, if you want to look at individual bonds, you can look at these type of charts on your platform, or you can screen for bonds. So back to you, Kirk.
That's a great point, Barb. And I want to make some point because actually the rate was 12% for the top one, even though they're advertised 11. But I think the point Barb made is really important and I want to accentuate this, is that Wall Street does not want to sell you bonds. They want to sell you stocks. That is the inherent piece of all their marketing and sales, is they don't really want to sell you bonds. They don't market bonds. They're not sexy. People, bonds are boring. But yet that's where all the smart money goes, is bonds. Not all the time. The last 20 years have been a little rough, but generally speaking, that's where the smart money goes. So if you think about bonds, there are a lot of tools that are available to myself and Megan as active institutional players. But for most retail investors, there's not a lot of tools available. You can find websites galore for charts and research and whatever on stocks. Try to find a resource on how to price a bond. There might be one or two. I know there's some available that I have. I don't know if they're available to the public, but there's some that actually give you pricing of bonds, but they're not great pricing. But you don't have that, and no one has any interest in giving that to you because they don't want you to buy bonds. They want you to buy stocks and whatever. So just understand that the resources are going to be more limited for retail than they are for the institutional people when it comes to bonds. Stocks, it's kind of all the same, but bonds is very different. So I guess getting back to my question, Megan, is given all the variety of yields and risks, like how are you looking at allocations for your bond portfolios with kind of composition and as well as kind of allocations?
Yeah, I mean, look, our general philosophy is we don't sacrifice credit for yield. If you want to stretch and add risk, go to the equity portion of your portfolio. Like a lot of firms, a lot of our clients are 30, 40, 50% fixed income. And so the bulk of that fixed income is sitting in municipal bonds, right? Municipal bonds or investment grade taxable bonds that act as the core. And the core should be the majority of your portfolio for fixed income. And, I think the thing is, what you really want to focus on with that core is the due diligence aspect. So who's buying the bonds, right? A lot of times people say, well, I got a guy and he buys bonds for me, right? Well, how are you doing due diligence? Because bonds, there's no risk until, of course, something starts to default. So typically we work with bond managers who have separately managed accounts or SMAs. Now, SMA minimums usually start around $250,000. If someone doesn't have that amount, then you look for a core holding in a mutual fund that is actively managed. And we focus on active management for bonds because we want someone looking at what's going on. So with our separately managed accounts, a lot of times the bond managers have credit specialists, and all they do is they are looking for what is, different things in the newspapers of what could look at to see what it would be a default, or they're looking at the provisions of the bonds to make sure the taxing power is there. So that's sort of the boring construction of fixed income. And then, you've got these little tilts in the bond portfolio. It could be 2% to private credit. It could be 3 or 4% to total return. It could be 1 or 2% to international fixed income. So you don't want to move your whole bond exposure to total return. You want to have sort of a decent allocation to it, but I'm talking 2 or 3%. So that's what's really key here. And again, I can't emphasize enough, as Barb keeps talking about, things like Morningstar are so powerful because you really want to be able to do what we call a look-through analysis and understand what you're truly buying. That's where people get caught swimming naked, is when they don't understand what they truly own.
Yeah, no, that's a great point, Megan. Yeah, I mean, as we get close to wrapping up, I did want to ask you a follow-up question, Megan, because you'd mentioned agencies earlier, and this is one of those areas that people talk about munis being tax-free, but agencies are kind of like like the middle child, right? They don't get a lot of attention, but it's interesting, and you're seeing 5.25 out, pretty much out to 10, 20 years on agencies. So can you talk a little bit about agencies and kind of like, is that an area like people should look at or be concerned with, or?
Yeah, I mean, it's definitely an area of the bond market you want to have exposure to. I think again, it comes down to due diligence, right? And the thing about agencies is, like treasuries, they typically are subject to federal tax. Certain agency bonds from like the Federal Home Loan Bank, they may be exempt from state taxes. So this sounds like an odd thing, but when you get your materials for your tax return every year, your 1099s, there's often with the bond funds a fun little booklet, right? And that little booklet will take your bond fund and say, this piece is taxable in this state and this piece is not. And they sort of break it all down. So there is a reason for that book there. So what I would suggest to people is, just be aware, particularly we've just come from tax season. Go look through your tax materials, see with your bond funds what pieces of them were taxable and what weren't. And the only other thing I would say with agency bonds to be aware of is that if you buy them at a discount, when those bonds are sold or redeemed, you may have some capital gains consequences. So you just need to be aware of that. Bonds are really tricky in general. And then when you add the tax return in, it's even more complex. It's I would tell you, when my team is inputting, one of the things they hate inputting the most are bond accounts.
I can't blame you. The systems are not designed for bonds. We have that problem all the time. It's like, oh, we got to do bonds. Like, the systems aren't designed. They're designed for equities, mutual funds, bonds. They're not streamlined for bonds. So I totally understand. All right. So Barb, as we kind of wrap it up here, final thoughts from you and where people can find more about you.
Now's the time to look at fixed income. And one of the things Megan mentioned earlier is locking in longer term bonds once interest rates peak. And so it really raises a question. Do I invest in a short-term bond fund, an intermediate-term bond fund, and a long-term bond fund, or a long-term bond fund, or an aggregate like an AGG, which covers the whole bond world? So I'm not going to give you the answer because really no one knows what's best. And the key, I think, is to remain diversified, not only in your stock portfolio, but in your bond portfolio. So maybe have a couple of different types of bond funds, because I think most of us, even wealthier individuals, really may not have the wherewithal to go through picking individual bonds. So spend some time screening for different types of bond funds, compare their expense ratios with their long-term performance. Morningstar is amazing. And if you want to invest a couple $100 a year, you can get the premium version, which gives you great research. So now is the time to consider adding some fixed income. Revisit your asset allocation of your portfolio. There's never going to be a time where everything goes up or everything goes down. Or I should say rarely. I don't want to say never, because in 2022, in general, stocks and bonds did decline. But if you held some cash, that kind of stabilized your portfolio. My name is Barbara Friedberg. You can find me at Robo-Advisor Pros, Barbara Friedberg Personal Finance, and on YouTube. And I'll see you next time here on Money Tree Investing Podcast.
Thanks for coming on, Barb. Megan, final thoughts from you, and where can people find more about you?
I love bonds, love the bond portfolio, but I really enjoyed this interview. I think it's one of these interviews that you did, Kirk, that people could listen to more than once to really understand the bond market. Bonds are great for portfolios. They stabilize things, but they have hidden risks. So you really, truly, want to be thinking through how you execute on your bond portfolio. And if you work with an advisor, say, look, can we spend a meeting just talking about what's in my bond portfolio and how should I look at it and what's my duration and what type of credit quality do I have in there and what type of bonds do I have? You can spend hours on this, trust me. So, I think it's a really important area of portfolios that often get overlooked because it's boring to some degree, but it's actually it's a valuable thing to know what you have in your portfolio. So I'm Megan Gorman. You can find me at Forbes.com. Kirk, thanks for having me on.
Thanks for coming on, Megan. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.